Last time I talked about the CMCRC and its major objective, that is to look at and assess the quality of the securities markets. In particular, what we were talking about there was how to understand whether market design changes are good or bad for markets. In this context, what we do is we look to the mandate of the regulator, and that mandate is very specific. It says that, and it's very specific all over the world. Regulators are required to ensure that markets are fair and efficient, so therefore changes to markets must also be fair and efficient. What that means is we need to measure fairness and efficiency, and that is the goal of the CMCRC. So to do this, what we need to do is to define these two terms to start with. So we define an efficient market as one in which it's cheap to trade and in which the price at which you're trading reflects all available information. So there are two key things we need to measure from that: transactions costs and price discovery. So if we're looking at how market design changes affect markets, we need to look at how transactions costs and price discovery changes pre and post those market design changes. The second element of market quality is market fairness. We also need to define this element, and we define a fair market as one in which the prohibited trading behaviours are minimised. Now, prohibited trading behaviours are defined in the legislation as being one of three things: insider trading, market manipulation, and broker-client conflict, such as front-running, best execution violations. And so what we're doing is we seek to measure those three things. We seek to measure insider trading by building a metric called information leakage, and we have a number of different ways of measuring market manipulation. And of course, if we've got the right information, then we can measure front-running and best execution violations. So the end result is that if you want to understand how a market design change is affecting the marketplace, you've got to look at these 5 metrics pre and post the market design change. You have to have a look at how it affects transactions costs, how it affects price discovery, how it affects insider trading, how it affects market manipulation, and ultimately how it affects broker-client conflict.